So March 5th? No, April 5th. We're cruising through the year, FOMC. For you guys that aren't in the trading room, I'll recap this quickly, that you should really understand that there was kind of a semi-pivotal moment that got us a little bearish yesterday early morning and then kept following through a little bit overnight into the early session today. So why we opened up weak on this session was a dove, Rosengren, typically a dovish Fed member and voting member, was a little hawkish yesterday when he gave his speech. And so the market was around 50, where was it? 65? I think 65 quarter. There were some 25 points below that. It wasn't a direct move from 65 to 40, but it was, something that might have gotten the markets to take notice that a hawk is, or a dove is being hawkish. The overall, the feeling is that we don't want equity market doesn't want a sooner rather than later Fed in raising their rates. They don't expect it at the meeting in a couple weeks. They don't expect it for a couple more meetings. They expect one, maybe two for the rest of the year. Anything more than that, anything sooner rather than later, has the initial reaction being bearish for stock markets. So that's maybe a reason in the last session and a half we've broke and gotten soft. Second thing for guys watching this live is tomorrow's FOMC minutes, 1 o'clock Central. Could be a market mover if they give a little detail of what went on 3 weeks ago at their last meeting. Maybe they were a little closer to raising rates and making this next April meeting live. This won't mean much to people watching this session on a recording in a few weeks, few months, few years, but it is for you guys watching it today on the 5th of April. That's what's going on right now. We're soft coming out of yesterday, maybe because of Rosengren's comments. At least know that a hawk or a dove was being hawkish and know what that meant. And we just kind of segue into, after we opened today, it's been some follow through, but not that extra oomph through 45, 46 on the upside, or through in the E-minis 37, 39 on the downside. They might get that. I just showed a chart of some juicy swing lows hanging out down there, and it might go while we're doing this meeting. I don't know, but I think that if they can get back through 39 even, they have a chance to run decently through the regular trading session lows, 37.75 right now on the E-mini session. But getting into this meeting, as you guys know, we've been doing this step one, ready, aim, fire concept for the last few weeks. It's important. A lot of good reaction to it from you guys that have watched it. And it's now we're going to go part 4, which is another trader. Dan has been with the trading room and the edge for a long time. He's turned the corner. He's done well. He's a more bond trader than E-mini trader, but uses correlations. As well as anyone. It's no coincidence, I think, that he's an appraiser by trade, real estate appraiser by trade, and understands the value of comparing and contrasting. And everybody, I think, does or gets to it once they get through the edge or enough of it. But anyhow, I'm going to reiterate this. Dan's step one last week. We had Peter's step one, George's mine prior to that. It's not necessarily the step one everybody should have. There's overlaps and common denominators that we'll all have, but your step one might not be right for me, but it is right for you. What's wrong is when you don't have one. If you don't have one, then how the hell are you going to follow or implement one, right? If you don't have a step one, then why have a step 2, 4, 5, 6, 7, and 8 in a whole articulated plan? Just throw it in the garbage. You got to know when to pick up your gun, or aiming and firing are irrelevant. If you fire before you aim before you're ready, you're not going to hit the target, or at least enough to keep yourself fed. And that's the key, is we eat what we kill. Now, something interesting happened over the weekend that I'll take everything back to trading. I've done it my whole life, and that was you guys seen a Periscope I did, and maybe some of you didn't, and it was John Hancock, second biggest building in the city. I was up there, and they have this thing called the tilt where you go out on it, and it tilts out of the building like 30 degrees. And I'm not afraid of heights, but yet I was afraid to do it, and I stepped back away from it. You can understand why. I did electrical work for 4 years after high school while I went to college at night, and point was is I did street light repair. I was up 40, 50, 60 feet changing street light heads. And when you're up 50 feet in the air, it's not like I was up there looking around. You had something to do. So if you're afraid of heights, you're not going to do that. I'm not, but I was some 20 years later up in this building, and I couldn't understand why. I talked to a roofer yesterday, and it dawned on me because he said the same thing. I never do that. And I says, why would you be afraid of heights? You're a roofer. He says, I'm afraid of anything I can't control. And immediately took me back to this business and why people might have confidence issues is they don't have their step one articulated. They don't have their exit before their entry. They feel like they can't control. You're going to be afraid of something you can't control, even if you're not afraid, in this case, in this metaphor, heights. So you got to get past the, if you're afraid of heights, you're afraid of heights. If you're afraid of taking risks, you're afraid of taking risks, whatever. But even if you're not afraid of taking risks, doesn't mean you're going to be a successful trader. You have to control the risk. And in my opinion, I was thinking about this last night, it shouldn't be called risk management. You know, when people say risk management's a popular phrase and concept and skill set, it should be called reward management. Because managing your profits is just as important and maybe more important than managing your risk. If you manage your rewards better, you might not have to manage a lot of risk in certain trades. You'll always have to manage risk because you'll always have losing trades. But if you take better care of your profits when you have a head start in a trade, that might not be an instance where you have to manage the risk because you never had it. You took the profits appropriately and therefore by default manage your risk. So the best way to manage your risk is to minimize the amount of risk you have to manage and the amount of frequency you have to manage it, which you have to be a good reward manager, knowing how to take profits, knowing that you'll never go broke taking profits. So this is really important to understand that you're never going to be comfortable with something you don't feel like you control. But you can't be a control freak either. What do I mean by that? Well, if you're a control freak, you're not going to control price direction. You're not going to completely control your emotions, right? Just like if control freaks try to control other people, their kids, their spouse, and they live a pretty frustrating life because they never end up controlling as much as they want to. So while we all want control, you can have a problem with it. But you have to have control that you know what you're going to do and you have a pretty logical, concrete expectation of how you're going to react before you act. How you're going to react before you act is knowing where you're going to get out before you get in. Same concept. So there's no surprises that you didn't blow up, that you didn't have a problem reacting appropriately. You know what you're going to do when it's a 3-0 pitch. Opening day was yesterday and this weekend for baseball, and you get a 3-0 pitch. You're not surprised. It's a get me over strike down the middle fastball, and you turned on it. You're not surprised. You were expecting that pitch, and you know what to do with it. So good hitters are good hitters. So enough of the sports metaphor and the afraid of heights metaphor. It's an important part of managing your risk is managing your rewards, and a lot of people are, it's hard to get profits, so know how to take care of them when you're getting them. And if you're consistent at getting the market to go your way, you got it. Don't try to reinvent the wheel. If you're good at locations and get the market to go your way and you're still struggling, there's a problem, and the problem should be a simple solution. The hardest part is to get an edge, to get a little bit of a head start. You make more money by increasing size, not increasing the number of ticks you're going to make. So Dan, just a brief introduction to Dan is he's an appraiser, been with us a long time, trades mostly bonds, and he was willing to talk to us like Peter and George did the last couple of weeks about his step one. And he says it's pretty, short and simple, and that's good. So those that are newer to not just the Edge but this step one series, make sure you're watching all these videos so you're not blinded. I don't want to go over and recap the other ones or what step one is. We did a whole hour video about a month ago on what this whole step one concept is. And this isn't step one of a 12-step get yourself sober type of program. Those are great programs, and they work for those people that go through it. This is just the first step, and it could be the only step that you need. It's important, and most people, I think, lack this. So let me do a couple things with Dan. Let me make him a presenter and then switch over our screens so you could show his. Hold on, Dan. Make presenter. Dan, it should have a pop-up on your screen to show my screen or accept the presenter tools. Yep. All right, good. I hear you. There you go. I see your screen.
All right.
It says
First
order.
off, don't laugh. Yeah.
Don't.
I ripped it off from yours. Don't laugh at all the stuff on there.
No, I'm not. I don't. There's a lot of things I laugh at. That's not one of them. The real quick, you're trading mostly bonds still, right, Dan?
Only bonds. I haven't traded anything else in a long time.
And how have you been doing?
Great. Just, ever since I came to Market Delta and learned about market correlation, that was really all I needed to have an edge to get some winning trades, and the rest of it has been quit doing what you're thinking about doing and do what Anthony says, because it's always right. Don't hold on to things. Don't let that one little idea turn into something, because I've had it happen too many times. Just even taking a shot on a one lot on a hunch can ruin your whole day if you deviate from how you've been doing it. So
I wish my wife would say that.
Yeah, I wish mine would too. But it's true. Anytime, like, I'm not sitting here talking to everybody today saying that I'm, a perfect trader. I'm not. I'm not even close. And my mistakes come from deviating from the copious amount of notes that I've taken and written down. And there's not a lot of rules. There's almost 2 or 3 rules. Just follow those, and that's fine. I go back and look at I really have had 22 trading days in a row with positive cash flow days. And then that streak ends. I can tell you it happened in December, on the last day of the year, when Anthony said, don't trade this day. And I said, I got to do it anyway. And it wasn't because I wanted one more day to close out the year for when it was not a big losing day, but it ended the streak. And I said, I should have listened to him.
Yeah. I never kept streaks because I didn't want to, and I'm not saying it's wrong to keep an eye on your streak. I never did, because the data wasn't in front of me, and then I didn't care to compile it. And the reason why is that I didn't want to get mad for sometimes, yeah, it's great. I know that I'm having a streak. I can tell you that, whether it's true 21 in a row or 19 out of 21, I know it's a good streak just based on the account growing in that week or that month, right? In that first quarter or whatever the time span is. There's nothing wrong with it, but don't let something like that anger you. What actually is good is that you knew that maybe you shouldn't have traded, but it wasn't a day that gave away, any part or chunk of the 21 days of profit, right?
Right, sure.
That's what's important. You're going to have
it was one tick. It was a one tick negative minus commissions also.
And you know what's cool? Yeah, so then your streak really didn't end. But not only that, but even if you traded the last day and it was a great day to trade, and you maybe lost a little bit of money, that happens too, and it ended the streak. But you got a streak to end, and that's real positive. Now, even though you're just a bond trader, you're watching what mostly?
Well, after I spent some time this weekend saying, okay, I need to boil this down into a step one. The step one is, to put it in a sentence, is I'm watching for changes in moving average in markets correlating at the same time. And that's it.
Well, let me write this down again, because that was good. Say it again.
Changes in moving average that correlate with the most important correlating markets, in this case, the ES. Until recently, I wasn't watching anything else, but I don't watch the NASDAQ, I don't watch the YM, just because the ES is all I need. And for others that out there that don't know this, I'm typically, during the peak trading hours, I'm in my car. What your screen you're seeing is my screen. It's a laptop. I stack the screens on top of each other, so I can flip through them as I drive from house to house doing real estate appraisals. And I've been doing it this way for a long time, to the point where I am more successful in the car than when I'm sitting at my station at home.
That's awesome. I mean, it's different for everyone. Some people wouldn't be. I don't know if I would be, but you've got that routine licked. I don't, and you don't either advise people jump in their car and put it on the laptop and it's going to work, but you've legged into it, and that's cool because you're comfortable looking at it and you have an expectation. Well, let me ask you this. What do you mean by that, moving average, to be honest with you? So changes in moving average to correlated markets.
If you're looking at the screen right now, look at where I've got my cursor around 1129. This moving average line is Hull's moving average, and obviously it's hitting the VWAP right here. Mm-hmm. This is a drop down in market delta set to I think a 10-period Hull moving average, and then you can select it to give you positive, negative colors. That's standard with market delta.
When you say 10-period, that's 10 bars?
Yeah, it is 10 bars. When you select Hull's moving average in the drop down, then it asks for the period. So I'm assuming it's 10 bars. I mean, it's universal to the Hull moving average.
Got it.
So as you can see right here, if you're seeing the down move here, mm-hmm. but the bonds are up today. They're way up. They've been up for like 10 days, and nothing seems to want to bring them down. You're coming right into the VWAP. So seeing this volume imbalance here and here is pretty expected. And this is exactly what I look for. It's something that normally I'd be taking a shot here if this was a year ago, but something that you have said quite often that has gotten through to me is it cannot start doing what you want it to do until it starts doing what you want it to do. There's nothing wrong with waiting a heartbeat for a little bit more confirmation than being the guy that takes the shot that, it blows up in your face.
Right. It's like on the railroad tracks.
Right. So this is just a perfect setup that I missed because I was getting back here into the office, where you get that move up and it comes back to retest it and you get a big fat volume imbalance right here. Like I would have jumped on that in a second, and it moves quickly up here. And you can see what's happening right here. For some reason my charts are not updating, but I haven't restarted this machine in a while. But okay, well this would, you can see who won out in this one. You have a double volume imbalance here on the VWAP, and it gets answered right there. I would say right here, if I had seen a volume imbalance, I would have probably jumped on that too.
What is that, a 3 reversal?
It is a Renko chart where the time is pi. It's 0.0314. Like George, I like to mess around with charts, and I have for a long time, and I spend hours creating charts. And one day I was creating something to give me you can see the name of this chart is fast entry, to give me a spot to get in for quick movements in the bonds. And for some reason I started messing around with pi and adding decimals to it, and came up like this is, for me, for a fast entry, it's the perfect time frame. And then below it I've got delta, and then this is just a histogram of this zigzag thing. And zigzags don't mean anything. Don't look at this and say, well, I could trade that. It's only there because of the movement that took place. Yeah, it's not there because movement's going to take place.
Got it.
What it does is it gives me something to glance at.
To visually see the rotation.
Right. Exactly. I can look at your P&F and see it too, and I know you. But for me, I can look at this from 5 feet away and know exactly what's going on, and more importantly, what not to do.
I like that. Let me ask you this though. All right, so the moving average, I get it, and sometimes that moving average goes green, red, green, red, green, red. At the moment, it starts to stay green. Is that?
Yeah.
Could be true to say, or not?
Yes.
True to say. All right, and then. But when you said in your statement, changes in moving average in most correlated markets, so you're seeing a change in the bonds up and the same time seeing it down in the ES, for example?
Absolutely. I have another sub-chart running on 133 ticks for the ES, which is basically almost giving you a heartbeat. Now, I'm pointing out these things here. I wouldn't have done anything with any of these without looking at the ES chart and confirming that it's doing what it's supposed to. And in this time frame that you're looking at here, mm-hmm. and 133 tick chart, they're always correlating, always. Unless it's a Fed speak day, they're always correlating, opposite each other. Now, it may not be big moves. Like you're seeing, like what happened here, it took 16, 18 minutes. There's a struggle getting down here while the ES was moving up because nobody's buying it. Mm-hmm. They're not thinking that this is going to continue because the bonds are super up today, mm-hmm. and the ES, got slaughtered overnight. This move, turning back, this only took 5 minutes to take all of that back. And if you look at what's happening right now at 12:08, on another chart that I've got on another computer, but at 12:08, that moving average has turned over to everything's red in the ES, and then by 12:13, it's really cruising to the downside. So you certainly would expect something like this to happen. Then about 12:18 or 12:19, it kind of levels out. So although I would never be here anymore, if I was here, I would be out here. I don't take much more than 3 ticks. I may scale and leave a 1 lot maybe, mm-hmm. but even when that 1 lot gets 1 more tick in value, I take it. I just can't help it.
Yeah. See, we haven't stumbled on this, but what's becoming clear to me is if you have a step 1, like defined, like you're supposed to, like now I know more people do or will, and Dan has, and Peter last week, but it doesn't have to become clear completely to me what Dan is doing, but it's completely clear to Dan what Dan's doing. And do you see how it fits the market relationship model, an order flow model, and has those same common denominators without being exactly the same? And that's the power of a step 1, that it's not clear to everyone. That's why it's really hard to learn from other people. Number 1, because they may or may not know what they're talking about, but let's push that aside. Let's say they know what they're talking about, but it's hard to learn from them even if you know they know what they're talking about if you duplicate too much of what they do, because what they're looking at is their step 1. It works for them. They're experts in it. But you got to pull out the main contributors of what they're looking at and fit it to what you want to do, and it will become clear, and your trades will be higher percentage, and you will strip the randomness out. And that's why listening to other people, there's common elements to what Peter does, to what Dan does, to what George does, to what I do, without being the exact same, but we're all right. As long as you could define it, we're right. If you have trouble defining it, you'll never follow it, you'll never trade it. And that's the skill that you kind of can't create. And I like what you just said, Dan. It struggled going down. Nobody wanted to sell it. So it took maybe, let's just arbitrarily say it took 20 minutes to go down and 5 minutes to take back what it went down. That's a key in
that should be
struggle.
That should be obvious to anybody that's watching the markets today. You should have knowledge, and I'm not saying everybody here doesn't, but everybody knows where we came into this at 9:30 in the morning about the lows that we were facing and the bonds are way up. Until that stops happening, expect it to continue. Even if there's respites where, the bonds are getting some buyers like they have for the last 5 minutes, but it's not really going anywhere.
Yeah.
And it's probably not going to.
Now, that's cool. I mean, I like the way you boiled down your step 1 in 2 sentences or 1 sentence, and then just with some quick elaboration. I think we're able to you guys got questions, ask them, but I think that with minimal questions, I understood exactly what you're looking for.
There's also, I don't want to say there's too many step 1s, because that is really, for me to place a trade, that is the step 1, but there's a sub-step 1 that starts at the beginning of the day, which is knowing what happened last night.
If anything.
Right. If nothing happened, don't have any expectations. After what happened last night, you should have an expectation to the downside today. And if you want to, I cherry-picked some trades here on the chart that I could show, including the only one that I got today. And there was one fade that, I like to fade it too, like anybody else, but I have a sticky on my laptop that says, if you're fading, be careful.
That's great. Doesn't tell you not to fade. It just tells you to be careful and recognize you're doing it. I like that.
Know that you are fading. Know you are going against it. And, those can work too. But when they don't, you really want to get out of that quickly.
Mm-hmm. What was the trade?
Let me show you. right here. Let me move this up just a little bit. Right here we've got this big imbalance moving up here, and then where'd I get in? Sixes. So right here. At some point in these two bars somewhere, it was flashing green. It didn't close that way, but it did. I took a shot, and then when it got to here and I saw this, I quickly placed the order there, and it got filled. Quick.
Nines? You're bidding eights or nines?
Nines. Oh, wait a minute. Are we on eights? No, that was nines.
Where was your loser?
The loser was probably...
what was your risk?
I don't set hard stops, but if this thing is going 3 ticks against me, I'm not gonna let it do any more than that.
Good.
Even though
that's good.
In my mind, I tell myself, like, you should probably use 5. I just can't. I just can't do it.
3 ticks for those, just to make sure when you're listening on in the future now. 3 ticks in the bonds is like 6 ticks in the S&P. It's 31.25 a tick in the bond, and it's only 12.50 a tick in the ES. So, and the bonds to me have always been, not to me, it's just, I think it's true to say they're a truer market. And the reason why I say that is there's not as much retail influence of people getting too long, too short like there is in indexes. There's not 500 stocks that make up an index like the E-minis or 100 that make up the NASDAQ. A 30-year bond is a 30-year bond. There's only one 30-year bond. Yeah, there's 30-year bonds in different countries or different, and there's different expirations, a 2, a 5, a 10, a not 20-year bond, all that stuff. And that influences the treasury markets. Don't get me wrong. They're very influenced on the curve and other expirations. But there's only one 30-year cash bond, and there's not 500 treasury expirations that are influencing the direction. So when you have a big update in the bonds, it's a good thing to recognize to say, are we down? Yes. Is the path of least resistance lower? Yes. Does that mean you're going to make money selling it? No, unless you qualify some good entries along the way. And even though we are weak, we've been weak. So you got to factor that in too. It's like, well, why aren't we going to 20? Or why aren't we going to 30? And it's because, well, listen, we were trading 65 24 hours ago. We're 25 lower than almost 24 hours ago. So we are quite a bit weaker, and we've priced in some weakness of maybe a sooner rather than later Fed. Is there another leg lower coming? Sure, there could be. But right now it's just kind of creating new value, new price discovery in this area. So you got to be patient and not be pressing trades when you got money into it. What are your winners look like, Dan, on average?
I will unload. I'm trading 4 lots right now, and something that we've talked about in the past when I sat in on that meeting with Woj that he did. I on occasion, or more than occasion, will in instances like this. Okay, this was a winner, and it's again not surprised to me when you take a look at these that it was bouncing off almost the exact same areas. We got bounces right here and right here, but oftentimes I will spread the exact same product. I've got a sub account, so I'll spread the 30-year bond if we're in a congestion period and it's going against me a couple ticks. I'll just spread the same amount, so I'll be holding 8, 4 long and 4 short, and then leg out using, this is the same chart but a larger time frame, and leg out 25% of whatever position I have at a time, being a little less tick sensitive.
It's interesting, and that may or may not work for other people. So instead of puking the position,
I just spread it. The reason for that is I like being in a trade, but also like it's frustrating being in the car and trading sometimes. And once I spread it, I don't have to worry about anything for a few minutes, and
I like that. I like that.
Give the market time to work itself out, but it keeps me focused on making trades and also picking spots that might take a little bit longer, but have they've got a good chance of working in your favor. When you're only working with, you release 25% of it, say you've got 4 on each side and you release 1, now you've really just got a spread that's offset by 1 contract, which is not a super dangerous position.
Right.
It minimizes the risk, and
you could still trade the trade.
Yes, exactly.
And it's a discipline and skill technique, but you're disciplined and skilled. So I think it's good, especially from being away. It's like I don't want to get out of this and but I also don't want to stay in it and leave my screens. So let me offset it with selling 3 and do like a synthetic spread in a sense, and then create that risk management, and then you could leg back out of what you don't want to be into. And there's a lot that goes around that. Your profit targets, let's say, I would imagine most of your winning trades are winning trades pretty quickly, where it stays, if you're long 9s, it stays 9 bid 10 trade. Is that true?
Yeah, I have days where, especially like this is the 30-year, and I trade the 30-year a lot, but sometimes I'll trade the Ultra Bond, which is the same bond, it's just much more thinly traded. So you can have the bounce around in that is much more. So I do that in times, believe it or not, of volatility where I'm not going to be in it very long. If it starts to head in your direction just a little bit in the 30-year, you'll already have been filled in the Ultra Bond, so it reduces your exposure, And I'll have days where every trade is an outright, and obviously those are great days. And I'll have days where, like, the first one off the bat becomes a spread, and then I take the rest of the day legging out of it. And what I have found from this is the days where I don't make money, the losers are very small. And the days where I do make money, they're consistently around the same amount. And then the days when I have more majority outrights are the best days.
Sure.
And I can't ask for more than that.
No. And your winning days are exceeding your losing days on top of that.
Yeah, exactly.
So it's higher average winner, higher number of winners, and that's called accumulation, and that's trading. That's risk-taking. That's all that stuff that we talk about. Ultra Bonds, what is that, a 50-year?
No, the Ultra Bond is a 30-year, but the expiration is more than 20 years.
Oh, okay.
And the ZB, from what I understand, and I've talked to the people at the Board of Trade, has less than 15 till expiration. What happens to the 5 years in between the 15 and 20? Nobody has an answer for me.
Yeah.
But you'll see.
Go ahead.
You'll see your dome on an Ultra Bond will show like 100, 150 most of the time, when your 30-year is showing 300 to 500. So it gets mowed through pretty quick. And here's another reason I do it. It's a bad crutch to have. But even when you're wrong, like if the bonds hang around and they're not going the way you want them to, but they're not going against you yet, the tick around the Ultra Bond on a one-tick winner will get you filled, and then the bonds will go in a losing direction for you, but you get filled anyway.
What's the symbol for that Ultra Bond?
UB.
And that's a CME product?
Yeah. Mm-hmm.
And that's a good ancillary to watch.
Yeah, if you are super fast, and that is, I have come to learn the reason why it'll drain from 100 contracts to 0 in seconds is because it's a computer-driven product. Mm-hmm. If you think about it, it's not just mirroring the bonds. It is the bonds. It's just longer expiration and less heavily traded. So that is a computer program you're competing against because it moves super fast. But if you can just get the direction of the 30-year right, you'll get filled.
Turns. So, you're catching turns.
Yes, exactly.
Yeah. No, that's interesting to do, watch and look at. So on your winning days, which are a lot more of your days than your losing days, how do you determine your profit target? Someone's asking.
I don't determine it. Three is my lucky number. I have
that's
been
a good sweet spot.
But I will usually, like, I got a 4-lot going. I will usually take the first one at a tick, and then the rest at 3. But if it doesn't get to 3 pretty quickly, like, I'm not hanging around. If it's just sitting at 2, that's great. If it's moving back and forth, 1 or 2, I just fill it and move on with life. And
the reason why 3 is your lucky, it's because it's a sweet spot of bond movement. It's like, they're going to move 6 ticks, 10 ticks, 20 ticks, and when you catch those slides, you'll be good at maybe keeping something on and pulling back because you really got them. And if you're not good at that, don't get locked in to just a 3-tick winner if you got a slider. You'll get good at knowing when that is. It should be obvious. Like if you got 2 ticks into a trade and it's like, I'm not taking a 3-tick winner. These S&Ps are getting smashed. There's just no way. And then bam, it goes 6 your way, but that's something you'll get with experience. But the reason why it's lucky is because it is a sweet spot. Remember, guys, 3 ticks is like 10 ticks in the S&P. It's 31 quarter a tick. So, and when I put bond trades on, I like taking a tick profit on something because it's 31 quarter tick. Say you've got 9 on, or you got 4 on. 4 is a good size in there. It's almost like having 15 S&Ps on, in a sense, and that's a good sweet spot of size. And I think everybody could get up to 4 to 10 bonds, no matter what you're wired for. But you got to walk up slowly like Dan has. And I think everybody can get up to 6, 9, 12 contracts in the ES if you walk up slowly. It's not, you don't have to be a huge trader, but you always can be better than one. Anyhow, if you have 4 on in the bonds and it doesn't, and it's giving you 1 tick and you take 1 off, you feel more objective because you've taken a little money and it's not fake money. It's 31 quarter. It's not like you're taking a $10, $12 profit. And your commissions are lower in the bonds. Quite a bit lower than the E-minis, and so you got a nice risk reward as far as that goes. Another question, Dan, is why did you choose the bonds over the E-minis?
I can tell you, my second day in the trading room, the first day I didn't understand anything that was going on, but what made me join the trading room, it's been over 2 years now, was
What's
that?
My picture? No, I'm just joking.
No, you called me. I took the on a Sunday night at like 7 o'clock. I had taken the trial, and you called me and we talked about it, and you said you'll probably join. And the reason I went to Market Delta was because their charts from when I looked at it a few years before had now had the green and red volume imbalance, which as soon as I saw that, I knew that was a serious edge. And then they had the trading room. So I'm in. Plus, it's $99. You don't think I lost $99 on a trade? Please, I've lost. I mean, if $99 is nothing in this game. So day 2, I'm at a stoplight early in the morning, getting ready to go to a house, and you're talking about correlation. And I type in, what is the correlation between bonds and ES? You said they're opposite each other, and I'm just like, he's lying. He's lying. And I pull over at the post office. It's there. I pull up the charts that I look at because I'm more familiar with them So they're not volume imbalance or breakdown, it's just candles. And I'm looking at it in the time frame I use, and I'm like, holy crap. Everyone I look at, every turn had a correlated turn. And I knew that everything you were saying was right. This is how pros do it. If it didn't have this, you couldn't do it. You couldn't do it consistently without market correlation.
No, you're right.
That's just it. And
if someone gave me one, don't go ahead, finish your.
Well, so I looked at it and I see the correlation, and I know the ES because I've made money with it and lost money with it, and I start looking at the bonds. I'm like, these things have a pulse. They're not frenetic like the ES. Let me just try this. So I just started trading a 1 lot, and they move gently in one. This is not always, but they gently move in one direction, then they gently move in the other direction in correlation with the ES. And as they go about their way, they don't come back on you 4 or 5 ticks the way the ES consistently does. And to me, it was just a no-brainer. It's much more laid back. I mean, I shouldn't say it's laid back because it's 31.25 tick. You need to be on top of it. But it's
a truer. The word is truer. I think it's a truer market. When you got them, you got them.
Yes.
There's not a lot of shakeouts, or as many as you'll find in the indexes.
And the other reason why 3 ticks is 93.75, which is almost an even 100. So it's easy to calculate, and
per 1 lot.
Correct.
Yeah.
Right. So
that's where your and I'm going to do in the future a ratio where your monetary goals have to be reachable, practical, and money matters. And someone that says don't trade the money, yeah, you do want to minimize trading the money, but you're going to have to incorporate and realize, have an expectancy. You're going to think about it. So just think. So don't try not to think about it. Just try to handle it better when you think about it. And that's kind of some of the things you're saying.
Yeah. When I first started trading, I was using a broker that would let me trade my retirement account with futures. And so I've traded big size because it was a big account. They have since said, we probably shouldn't have been letting you do that, so you can't do it. So that's where I have moved to a smaller cash account, and which is better anyway for me because I'm in my 40s. I wasn't going to be using the money in the retirement account for 25 years. So I have a smaller account here, which keeps me in the fours, but I have an asset, a house that's the 7-year tenants are moving out and it's getting sold in June, and I'll be spreading probably, I hope to spread 40 lots eventually, but I'll probably move to 10 and then 20.
And you're doing this because of reward or because of track record?
Yeah. I mean, if you think at it from my perspective, and this is why I do keep track. I've got a spreadsheet and I go back and look at it, and on days where things didn't work or, the numbers aren't the same, I've got a little note to it. But, on the days where, I'll have as many as 6 outright trades, like I look at that and say, if I could do that every day, even with a small account, I wouldn't need another job, even close to needing another job, but it doesn't go that way every day. And I look at the days where I've spread, and they're good to okay to small loser. Because if you think about it, when you're spread, especially with the same product, you're not doing anything more than being an outright. You're getting out of one on a turn, hoping to spread the difference, and giving yourself a little bit more breathing room because it's a smaller size gives you the ability to take a slightly bigger winner. Like when I do that, I'll still 3, but I will do that on almost every one when I can, versus like giving it 30 seconds and scratching it, or give it 30 seconds and saying, I'm going to just get out on a one tick. So with patience in spreading, just it gets the bottom line moving in the right direction instead of having dead days, where nothing is happening, you're not making anything, or you only made one trade.
You're doing it the absolute right way, and you've got accumulation in your favor. And so it's like anything else in a business. You're making improvements as you're making money. Most guys are making improvements to make money, whereas you're looking to make improvements to make more money. And,
right.
and then you ultimately know you got to bump your size and still keep the same objectiveness that you've had with these 4 lots, with 40 lots.
Exactly. I look at this and the tenets of it, the basis of it is not that different than what you're doing. It's just doing it in a way that makes sense to me, to my mind. Right. But at the same time, it's market correlation and, staying on top of it and not letting something get away from you or blow up in your face.
After you guys go through the edge and understand not just how important correlations are, but actually understand how to use them, could you imagine now if you were just given one dome, one chart of the bond, and that's it? You couldn't look or see or hear anything about any ancillary?
I know exactly what would happen. The same thing that happened when I traded the ES before I came to your room, which was not pretty. And the reason, just a quick story, the reason I started trading the ES is because before I was an appraiser, I worked in an office at a mortgage company and I traded stocks, and I did good. I could double an account in a year. For about 10 years, I didn't trade because I was running my own appraisal business, and the idea of trading on the road didn't exist. There wasn't the wireless capability. When it finally came around, I called my broker, who said, well, this is a very old track record, but you could trade back then. If you can trade, you don't want to trade that. You want to trade this. And he shows me how to pull up a chart of the ES. And I look at it. I see what it is. The next day, I traded that thing. I made $5,000 on 4 lots. What I didn't know at the time was it was during the financial crisis meltdown. Dow had a 200-point swing that day, and I just got lucky. And I proceeded to, over the next, it probably didn't even take 10 days, drain that account to 0. But it got me hooked and thinking, and that's, as I moved through my progression, I realized this is a business. Otherwise, the thing wouldn't trade 1.5 million contracts a day. Somebody knows what they're doing. There are professionals out there, and that's how, when I finally ran into you, I realized, compared to everybody else, and I know you have to talk about that all the time because I'm sure people from all over the world are saying, this isn't what I hear from everybody else, so you must not know what you're talking about, but it's the other way around.
Yeah, well, I don't remember. I remember talking to you, but not on a Sunday night.
It was definitely in the evening. I'm pretty sure it was a Sunday night, but it was right around the time my first and only kid was being born, so I wasn't getting a lot of sleep back then.
No, that's good. And I knew you. I knew, I could tell you this, not knowing the conversation, I did know you were an appraiser, because one thing I ask people, and that's why I told you you'll sign up, because you know that correlations is what you do for a living to value price. Why the hell wouldn't you do it trading?
And that's what I realize. That's what everybody in a professional capacity is using, and it becomes a self-fulfilling prophecy. A Bollinger Band may have some effect because lots of people are using it, but those lots of people are retail traders trading in small lots. Professional traders trading in large lots are trading on market correlation, and that's what's really moving the markets. And knowing that, it changed everything for me. It got me to become profitable, especially when I realized I should be trading the bonds and not the ES because it made more sense for me. Plus, the way I charted out, it just looks it makes much more sense. And right away, started turning the corner.
Let me ask you this. Sorry, go ahead.
No, go ahead.
So another question is, the FOMC and Fed speak make the correlation from opposite the same. Do you still trade on FOMC days?
Typically, no. I will in the morning because before they start talking, it's usually okay.
Right.
But I rarely trade after 1 or 2 o'clock anyway because the bond market is not the ES, and the moves become much slower. Sure. And when I am trading after 1 o'clock, it's because I'm legging out of a spread. I'm not gonna engage in a outright or a spread unless something's going on, unless there's, and it's not FOMC, but if there's something happening in the afternoon or wildness is happening in oil, which is something like I'm watching oil now, which is really the first time I've added another ancillary. I've got the NQ and the YM on subcharts. I rarely ever look at them, but oil has become, you have to have it right now.
That's part of
to look at.
Part of the right correlation. That's what we should call it, a correlation community.
Sure.
That's part of being in the right community is they're talking about things that matter.
I would never have, if I somehow was muddling my way through this on my own, I would never have thought to look at oil and the ES
right,
to see if they all of a sudden started correlating. It just would never have occurred because they did. That's not what they do, but they do now. And I've learned that because being in the room. And
they will until they stop.
Exactly.
It's like, be simple about it,
As it got back through the 40s and into the, I think it almost made 45, it started to decouple, and now that it has dropped it back below, it has started to, the same thing has started to happen again.
The other question, what is the Ultra Bond per tick?
Same thing.
Is that in half ticks or is it full ticks?
No, full ticks.
Full ticks, just thinner.
Yes, very thin.
And so therefore faster.
Yep.
An outright, for some guys that might not know the lingo, is just one product. So when you talk about an outright, it's generally you buy, 3 contracts and you sell 3 contracts and you're in the same product and you're an outright trader versus a spreader.
Yeah, if I could find a broker who would treat my synthetic spread as a spread because it's the same contract, I could do a lot more than I'm doing now, but there isn't anybody out there. They say once you have a sub account, they're separate accounts.
Outright.
They're outright, yeah.
See, so that's what an outright means. One other question, do you look to leg into your size, or are you just all in usually with your 4?
I always go all in because I treat every initial trade as an outright. I don't. Now, believe me, I've got my second dome up there and the fingers on the trigger to spread if I need to. But I am approaching it as an outright. And when you talk about people like position trading and trend trading or whatever, when you want to get in and have it go 10 ticks against you, you better know at least where and why you want to get in to give yourself the best chance of making money. And so I approach it that way. And then another question nobody has asked, but how often does that spread my outright end up going my way anyway? Almost every time. Really. About 80% of the time, if I was willing to take 4 to 5 ticks of heat, I end up getting what was originally going after.
Well, that's
anyway.
If you would have told me tell me in a vacuum that you'll buy 4, and if it doesn't go, you'll sell 4 in a sub account, I'd say you're just not willing to take losers. But knowing what I know, what you're looking at, and what you're judging, and then the discipline of just giving yourself more breathing time and the discipline of your market intelligence. So if you didn't know what you know and you were just doing it, it reminds me of that guy that I traded with who had no market decorum, even though he was in a prop firm, he was brand new. He just would buy the Euro stocks and sell the DAX when he was wrong. Just a totally different but similar market.
Yeah.
And he wouldn't do it with the discipline to leg out like you are to stay with your bias. He would do it just because he didn't want to take the outright loser. So when you say what you're doing, it works for you because you mitigate your risk. It's an expectant outcome that you have you don't want to do it, but you know that you can do it, and then you have less emotion to puke the loser,
Right.
And then you're not, it's fair to say that you're not taking the loser all the time. You actually were right. It's keeping you in the trade.
It's keeping me in the trade is the most important thing because I found myself, like, I'll trade, sometimes I'll get up early and trade before hitting the road. Like, I would take a couple of outright losses, and then I found myself just leaving the market alone the rest of the day. And so I thought about it and came up with this. And the way I look at this is, like, you got your winning days, small losing days when they happen, and these days, when you spread, I can almost always turn it into something. It may not be a lot, but it's something. And it keeps me trading, and it makes a couple of bucks here and there. More than here and there, but I mean, it's not obviously as good as the days where, like, you get a bunch of outrights going your way.
This is a session I might even listen to again. I mean, Peter's session and your session, you guys are both just quality first steps that were even above and beyond what I thought. I knew it would be helpful for others, but it's gone above and beyond that because not that I gave neither of you guys credit. I'm impressed that you've taken this and turn it into an intelligent, thought out, but yet simple. What am I looking for to pick up my gun? And I'm really excited to have come across this whole concept of what does it take for you to pick up your gun. I think this is a very powerful way to get people to not learn, but to learn by doing instead of trying to learn to do something. You learn by, you explain to me what you want to do instead of me explaining to you all the time what I'm doing. And I think that's the protocol most people go about when learning is, hey, listen, there's a journeyman carpenter and an apprentice carpenter. He learns a lot from the journeyman. He didn't follow him around and hold the hammer the exact same way and hold the hammer on the left hip the same way and measure the same way. I mean, there's always nuances to the guy you learn from. Obviously, it's important to learn the right stuff, and I think about this for a second. Dan, how long have you been an appraiser for?
15 long years.
15 years, so good 13 years before you met me. You've been around a couple of years, right?
Yeah. Mm-hmm.
So 13 years this guy's been an appraiser. And he never dawned on him to value price like he values price in his real, quote, real job. And what's the only tool, what's the most important tool in appraising homes?
Are you asking me or are you going to tell me?
No, I'm asking you.
Price.
But comps, right?
Oh, of course. Yeah, the price of the comps, sure.
Price of the comps. And that's it. That's the whole. And if you don't have comps, a bank is going to be comfortable financing the deal? Of course not. They need comps. And then and then it could even be like, and you know this because you appraised during the financial crisis, where the comps got overdone, right?
Sure.
And they were like, if banks were willing to finance at high prices, it must be okay. It must be okay. Almost be okay. And then there must have been a tail at the end. Did you know a top was coming before the top came?
I had an unfair advantage on that. Is I worked for the Federal Housing Authority and got my first bank-owned property order in early 2006, January, and I didn't even know what I was looking at. These people had walked away from a house they had been in for a year and a half. And then when I'm pulling the comps in the neighborhood, I'm like, they were $35,000 underwater in a year and a half. So, and then after that, the floodgates kind of opened. But the rest of the world didn't see it until maybe later in 06 or early 07.
That's exactly right, early 07.
The way I knew, there's a we're right outside Washington, D.C., and Fairfax County is the second richest county in America because there's so many people here living off the government. And when the median income for Fairfax County could no longer afford the median sale price of a home, and that happened in '05, like we all the appraisers that I know all looked at each other and said, like, that's not good.
How long could this last? And it lasted another year and a half.
Yeah, maybe a year and a half.
And really inflated the bubble.
Yeah.
It's a fascinating process that, and it wasn't really a 10-year bubble. It was '04 when to late '06 when anyone who wanted a home loan got one, and they just creatively approved everyone. That's it.
If you think about then, Fairfax County isn't the only county where median sale prices of homes were eclipsing incomes, yet people were buying homes. How were they doing that? They were using no income verification.
Yeah.
Because they had good credit and they had they had low down payments, doing FHA loans. It was a top heavy tower.
Or the adjustables.
Yeah.
Put them in an arm to justify the risk.
Mm-hmm.
They know it's going to jump, and they were able to afford the front end of the arm, and had no chance at realizing the back end of the arm, or when that kicked in, was triple your mortgage payment.
Well, their loan officers were saying, "Oh, you just refinance. You can just refinance."
And they could, and they did for a while. They were refining out of refis, and that was more money for brokers, more money for everyone on the money train, appraisers.
Yeah, from '03 to '06. I was at some houses every 6 months like clockwork as they just milked their homes as they went up in value. And, people said appraisals were part of the problem. Appraisals aren't fictitious. If you live in a townhouse community and the last 3 houses that sold for X, X, and X, you'd probably get that for yours too. So that is what it's worth. And when it just went up 10% in 6 months, that's not my fault. And when you took that money out and put it in your pocket and then you're upside down because you milked your house, that also is,
not your fault.
Not my fault.
The people that were at fault were rating agencies, investment firms that were able to package crap loans as good loans and find buyers for them. That's it.
If anybody out there hasn't seen The Big Short, it explains it very clearly, but that's exactly what it was. They were taking, and this happened when I work in the mortgage industry, you would have loan packages get sent back from banks because they didn't like something about it that they initially might have glossed over. And now you're a small lender that's holding that. You have to sell it. You can't, you just can't service a loan in that kind of debt or you'll go under. So you spiff it up and you send it to somebody else who says that they'll take it for maybe 95 cents on the dollar, and then they package all that together and sell it as a collateralized debt and tell everybody, oh, this is good stuff, and it's not.
Yeah.
And that happened. That
creativity, beyond borderline fraudulent activity, created a bubble quickly. But I guess it all started in '04, not to turn this into a mortgage meltdown, but it's actually really relevant because it created the best, at that point, 2 years of my career, '07 and '08. And so the understanding it was important, and correlations played greatly into it because there were companies of stocks I had no idea, IndyMac, State Street. They were going to zero, and that would be the stock that drove price. So I would go and sell and see, all right, hey, Anthony, watch, this was part of being around prop guys was State Street. You pull up State Street on a chart, they crack that 50 cents in one sweep, you sell any stock index, and 5 seconds later it go down. Fannie Mae, Freddie Mac became two of those stocks when they were getting beat on, and it would just go. It was like the flavor of the week.
Yeah.
Countrywide, it's a little bigger one when that went, and obviously Bear Stearns was the first one. But again, there were stocks I can't even remember now. I had no idea who they were, but because it was a hot topic, and who was the next servicer or mortgage people that were going down. But I guess in '04, they pulled the tape from YouTube. It was a video, and it was the Senate Banking Committee approving 9-to-1 to 12-to-1 leverage for major banks. So instead of monetizing every $1 you had on deposit into 9, they could do 1 to 12. And that doesn't sound like a lot, but it's almost 30%.
30%, yeah.
And that also fueled the, hey, there's a lot more we can lend notion and fill the pipeline. That make sense?
Yeah. You were just naming a list of some of my largest clients, IndyMac, Countrywide. I was at a Jiffy Lube, and I look up on the screen, and IndyMac, who owed me a lot of money, just went out of business. And I'm like, oh, great. But then things actually, they put in a comptroller that used to work for the Federal Reserve to just pick the bones of that thing. And actually, things picked up greatly as they just got rid of all their distressed assets until there was nothing left. And they paid all their bills. But like Countrywide was also when I worked for Countrywide, they would send over orders with an expected value on them, and they would say this is what the homeowner says his house is worth, and they felt like that deflected them from any, culpability, and this would come through an appraisal management company, which they owned, and I called the management company and I would say, like, this value shouldn't be on here. They would say, our lawyers have said that this is perfectly okay. And I said, well, all right, well, this is an unreasonable expectation of value. Man, I want to take this guy's money for the appraisal. His house is nowhere near worth that. And they said, listen, don't ever call here and say that. We're not in that business. We are in the appraisal management business. We send you orders. You send us appraisals. Okay? This is very early in my career. And I said, well, all right. And back then, management companies weren't licensed. They could do whatever they wanted. They are licensed now, and that's only something that recently happened. But
what would you do? An accurate appraisal, and they didn't care?
Of course.
Yeah.
That's right. That's right. Just, prior to that, because Countrywide and their management company was the very first management company I ever worked with. Prior to that, my clients were all individual lenders who would call you and say, hey, I got this house over here. And I made my reputation by not wasting people's time. They would call up and give me an address. I would do a comp check and tell them this is what I see on it. And if it wasn't what they needed, they might call another appraiser. They might not. They might say, hey, this is just a waste of time. But it's never hurt me. I mean, I've been busy for 15 years. And when Countrywide went out of business, Bank of America absorbed them and took over their appraisal management company. So the shenanigans don't cease. I mean, they have staff appraisers that work for the management company. Now, I'm not one of them. I'm what's known as a fee panel appraiser, which means I get overflow work. I don't work for them. They have no influence on me, but they certainly have people on staff there that are doing the appraisals for Bank of America as we speak. And Congress has told them that they need to sell their management company, and they said, we don't want to. And they're working that out. But this has been since 2008. Bank of America's had captive staff appraisers doing their own appraisals. You think there's no influence there? It's ridiculous to think there's no influence.
Yeah, of course. Everything is when everybody's on the money train, nobody sees the mountain it's about to run into until after it hits that mountain. And that's why bubbles are bubbles. It's like, how doesn't anybody see it? Yeah, but not enough to stop it from growing and then make it poppable. But that Big Short is it is a good movie because it explains I think as well as you could explain the complexity that some of these Wall Street banks created. They created such great complexity, Dan, that they didn't even know what risk they had on their books.
Right.
They lied about it, sure. They were lying about their write-downs right along. But
the criminal behavior took place towards the end when they realized that these collateralized debt obligations and mortgage-backed securities that we're selling, they were really probably going to fail, and began writing their own insurance policies against them, selling a Teamsters fund, a pension fund, $500 million worth of mortgage bonds, and then taking out an insurance policy against it, not telling the Teamsters. I mean, that absolutely happened, and how nobody got arrested is criminal.
Talk about fraud at the highest level almost possible.
It's because the money was so big, and the people that had that money contribute to politicians that they weren't going to go after them.
Yeah, I mean, there shouldn't have been there should have just been some arrests, a couple dozen. They could have thrown a couple dozen people in jail at least, and you didn't have to go and get the thousands of people who would have had their hands on it, but there should have been some bigger ones that, listen, you're a CEO of Goldman Sachs, Merrill Lynch.
Mm-hmm.
Bear Stearns, 100-plus-year-old companies that are just flush with success. And you essentially, if it wasn't for public money and bridge loans and backstopping of the Fed and lowering the interest rate to zero, you would have brought that company under. How good of a CEO are you? You suck. Should have been fired.
At a minimum.
At a minimum, should have been fired, let alone going to jail. But some of these guys kept their jobs and the parachutes and stuff. Hey, I knew that it wasn't, what had to be done was done by the government and the Fed. I know a lot of people, it's not popular to say that. There had to be some sort of backstop. The fact that there was no fallout and people going to jail was what was the ultimate shame. Not that Main Street bailed out Wall Street. You almost had to do it to save Main Street, but they should have thrown some of these guys away, and they didn't, and that's the shame of it all. So what are you going to do? You just got to go out and value price and try to buy bonds cheaper than you sell them and sell the S&Ps more expensive than you buy them back. Take care of yourself and your own. But, Dan, I appreciate you doing this. This was a great session. I've recorded it for those that might have came in late, and we'll upload it within the next couple hours like we always do. But who wants to do it next week? Anybody? I know there was a few people. Dan was first. The chart symbol Bill's asking, Dan, is the chart symbol UBM as in Mary 6 for the Ultra Bond?
Yes. I've had some challenges. It depends on who your data provider is. I've had some challenges getting it through Market Delta, especially when you're using, I think, CQG.
What are you using, IQ?
No, you're right. It's IQ that's the problem because it has a different symbol. But with CQG, it's UBM6.
Yeah. They'll have it. IQ Feed, if that's your data provider, will have it. It's just a different symbol that you got to look at their symbol.
Right. And actually, now that I recall what happened, I had tech support on the line from Market Delta, and it turned out because the Ultra Bonds they're not exotic or anything like that, but the broker had to flip a switch on his end because he wasn't broadcasting the data to me that they could pick up.
That's something you guys might have to do is talk to your broker if you can't see it and you're pushing CQG data into Market Delta charts. Just have them.
Yeah.
Because it's a CBOT product, just like the other bonds are, right?
Yes. Mm-hmm.
All right, real quick, though. James asks, is reliance on moving averages really appeals to Jim? Having sold a home in California, he really had interest in what this one had to say, so he appreciates you coming on. Random question, what's considered low commission charges? What is, you might tell me what your commission is for your bond?
I think I pay $2.20 a round trip. So it's like $1.10 or $1.20 per side. So it's cheap.
$3.50 if that's a round turn, Chad. So someone's asking me about what's a good commission for the ES. It depends. $3.50 per side is not good because that's $7 a round turn. If you keep it below $4, you're in good shape. A round turn though, buy one, sell one, $4. And then remember, don't try to structure and create a strategy that fits with your commissions. You can always lower commissions if you're trading enough size, not in and out, but enough size accumulation for the day or the week with seat leases and membership that you don't have to spend a whole lot of money to lower your commissions as a member. But you want to have a track record of making a little bit of money, but trading enough size to say, hey, this justifies it. I'll pay for the application in like a month, and then I get super low commissions that are competitive. That's the right way to leg into this business, and I think most everyone doesn't know about commission reductions that they could get based on at some point justifying with the size they trade. George talked about that a lot. So yeah, TD Ameritrade, he says, charges $3.50 a side. I didn't think there would be cheap commissions, and they're not because that's $7 a round turn. TD Ameritrade charges more because they can and they have to. They have to pay for their commercials and their exposure. They're the big dogs on the street, so they and they're a big stock house, option house. Thinkorswim is TD Ameritrade. That's their option side, and they're more stocks instead of futures, even though they offer futures. So if you're going to trade straight futures, which most of you guys are, I suggest you get a futures broker and go from there. Do you mind telling us who your broker is? Someone's asking, Dan.
I use AMP Futures, and I got to say, if you're self-sufficient, That's fine. They're not nice people when you call them. They're not easy to deal with. They are a-holes. But you can go to their website and see their commission. They don't dick around. It's right there, and it tells you what it is, and it's low. Their commissions are low, and you can get them even lower if you're trading volume. But if you need tech support's okay with them, but like if you got to call them, it's never.
But you never have to. I mean, but you like them based on. Yeah. Other than that, it's worth having them.
Yeah, and I have my retirement account with TD Ameritrade, and they are, they have a flawless, seamless system, and you pay for it. Their commissions, they don't negotiate commissions hardly at all.
Yeah. Well, it's like that's what it is it's like you get what you pay for, and if you want full service and low commissions, good luck. The only way you're going to get great service from a broker with low commissions is be a member with, and even then, I'm not going to get into my experiences. I'm treated well and have been, but I get back to this. Just because they're a broker doesn't mean they know a lot about trading. So you could be with a great brokerage, and the particular broker you have used to sell shoes, and he got a job selling trading accounts. So they're unique. Good ones are unique. You just want to be comfortable with the money that you're comfortable with the money that you have in that account, right?
Right. Yes, and I would, like with TD, I don't have a problem leaving my retirement account there because they've been around a long time.
Right.
And futures, there was a case a few years ago where a futures broker went out of business because they were using customer money to trade, and they bankrupted the
PFG.
Thing. One of the owners was a former senator, and it was a huge mess.
MF Global, and then followed up by PFG, and it got a lot of people nervous. Now,
yep.
That's why you don't need as much money in an account with the leverage you get. And you could, when people say you got $200,000-$300,000, you might not need that much. I mean, if you're going to trade $200,000-$300,000, that's different. But don't overfund. There is underfunding, and that's usually what people talk about is underfunding, and that's a problem. But overfunding is a problem that most people don't talk about. And if you overfund, you not only have risk of that brokerage going under, which is a low risk. I mean, it's happened, but it's a low risk. But you have the bigger risk is you devalue money when you have too much of it in, and you'll tend to trade bigger size than you should. You got to build up to the size. Your size in your trading account should not be the justification for the size you trade. Your performance should be indicative of what you trade and work up to that, number one. But number two, you devalue money because there's a lot in it, and you're like, I could take a bigger loser because it's 2% of my overall risk or overall account size, and that has nothing to do with the skill and what the price and market is telling you. So overfunding, we'll do something later. I don't want to get too much into it, but there's a sweet spot for everything, and a sweet spot for the size you trade to your monetary objective per day, per week, per month is important, and then also what a sweet spot in your account should be. So you guys, hey, listen, it sucks if you got $50,000 in your account and your broker goes under, but it's better than having $200,000 in there, right? Or if you have 50 instead of, you have 20 instead of 50. So the sweet spot's different for different people, but there's no reason to have too much money into it. So let me, and that's good. All right, one more question here. Dan, do you use 5 and 10s as correlations? 5-year, 10-year note?
Not the 5-year. The 10-year I do, but I mean, it's like looking at the Ultra Bond. They are not going to deviate from each other, and the 30-year is gonna move before the 10-year almost always. So if you're trading the 10s, you should be looking at the 30s, but I don't trade the 10s because they just 3-tick move takes forever.
It's muddy. Yeah, it's a thicker market, and the 5 is even worse, and the 2's even worse.
I look at that dome and I go, 5,000 by 5,000? Are you kidding me?
That's why what is important there is if you're long the bonds to see it like 11 bid, 11, because they trade half ticks in the 10-year note. So it's 11 bid, 11 half offer, and it's 5,000 up. If it goes 11 half bid, that's good.
Yeah.
Either you should have went up or you did go up or you're more confident in your long position because an offer going bid or a bid going offer in a thicker market like the 10-year note and even more so in the 5-year note, it's more important. It doesn't take much to have oil go offer to bid or the DAX go offer to bid. but it takes a lot for a 10-year, 5-year note to go offer to bid to offer, and that's important.
I have found, although that is true, like you said, it's such a thick market. If you want to watch correlation, set yourself a very fast, like 133 tick ES and a pretty fast bond, and just watch them on two screens. And you'll see, you may not see the bond move exactly opposite right away, but you'll certainly see as the ES changes course, you'll see the bonds, they'll stop, and then they'll turn around and change. Again, it depends on the time of day. Like right now at 1:15, things are pretty slow, but early morning and during prime hours, the ES moves much quicker and gives you a telegraph of what's happening with those 30 years. And like if you like to trade afternoons and you're willing to watch something not move for a little while, you do get more of a delayed reaction in the bonds, sometimes like a minute or 2 minutes before they start to do what they're supposed to do because it's just being more thinly traded. And for me, I know, like I'm not waiting 2 minutes to get what I'm supposed to get. I'll have spread it, after a minute. So I tend not to try to trade in the afternoons just because it.
Yeah, I don't blame you. And you're in the team room. I see you in there. You're in there most of the time?
Yeah, I haven't been in there for about a week because it's springtime here, and I'll go in after this just in case anybody wants to ask some more questions. But
Perfect.
Springtime in D.C., last month's orders in March were double what February was because so many, plus we've got the president's leaving, all his people leave, new people move into town, so they start looking for properties already, and so it's super busy in the appraisal world right now.
The election cycles even up to
yeah,
that makes sense. Now, what's your overall feeling on the real estate market?
Well, we're seeing in this area as part of I don't want to bore anybody with it. As part of an appraisal, in addition to providing settled comparable sales, you also have to provide active listings that are as germane to the situation as your comps, showing that they're selling or asking around the same value to show market continuation. Like I had 2 today. They're both townhouses. I couldn't find one listing in the neighborhood. I've got my sales because with sales you're going back a year, but listings are today only, and there were none, not even under contract. So you've got to go outside the neighborhood. So anyway, what's that showing you is a lack of inventory. Yeah. So that's giving us a nice pop, at least in this area, because people that are selling their houses, and I got mine coming up for sale soon, and the lady that's living in there, she's a realtor, and she's giving me a sale price. I'm like, you're out of your mind. There's not one house for sale in the neighborhood. The last 2 sold for $5.25. You think I'd sell it to you for $45? Forget it.
Yeah. Well, she's talking to the wrong guy. You're in the business.
She knows that. She knows that.
She's trying to speak you.
Exactly. She doesn't want to move. And I told her, this is about the time they told me to quit trading my retirement account. I said, well, I need to get I told her, I said, listen, I want to break your lease and sell you the house now. Or if you move out now, I'll give you a bonus, or I'll sell you the house cheaper now. She wouldn't budge. So their lease ends in June. They want to hang around. I said, you're not staying. And my brother is a realtor. He will list the house and not charge me anything. Mm-hmm. So you bring me a buyer between now and then without listing it, we can make a deal and you can make some commission. Otherwise, you got to go.
I mean, the reason why I like talking about this so much is price discovery. It just moves a little slower for houses for obvious reasons. But it's the same forces that judge value and push prices. And realtors do not make a market. And because I had a friend of mine tell me that, he's going to list my house for this to see if there's any interest. I said, I got news for you. I go, he can list for your property wherever the hell he wants to list it. But the thing called a bank is going to determine what the value and where you're going to sell a house. I says, there's more risk in offering it too high because you're going to get less showings early on. And you're not going to get more because you started higher. Obviously, if you start way too low, it'll bid through it. But a realtor thinks and tries to make customers think they're market makers. They're not. And even the appraiser, you guys are just market reporters, price reporters.
Right. I try to explain that to people. It's just simply reporting what's happening in your neighborhood, ma'am, because you think price discovery doesn't happen fast, but when you own a car dealership and you now have to come to the table with cash for your refi because the appraisal came in lower than you expected, that guy discovered price and called me right away. And when we have the discussion about the appraisal report, And I say, sir, it seems to me that the motivation here is not what you think the house is worth, because you haven't said that yet. You're just talking about the fact that you need it to be worth an extra $100,000, so you don't have to come to the table with cash to do your, that he's got some kind of bridge loan for his car dealership.
Right. Yeah.
He had a hard time arguing with that, but he certainly presented additional comparable sales to the lender that I then had to turn around and explain, and how I explained them was, these are all twice as big as his house. They're not his house. He lives in a split foyer. These are all colonials.
Yeah,
Thank you.
There's not a comp. I mean, if there was a
Right,
comp,
exactly.
they would have been on there.
Right. He just picks houses worth what he needs it to be. He doesn't, and he had a realtor do it. And that shows you how little the realtors know too.
No.
But a realtor is a commissioned salesperson who simply wants to tell that person what they want to hear. So
Yes.
maybe he hires them when they decide to sell their house.
A good realtor is a good manager of their expectations by, and I told my friend this. I said, the guy is good probably because he manages your expectations. He had a few people that come in, and the realtor didn't say, oh, that's great, that's a lot of traffic. Because if he says that, then your customer gets excited, he thinks he's going to sell it soon. He tempered it. He says, nah, we got to do a little bit more. They're all setting you up to accept what? Lower price. Realtor doesn't care if you sell it for $20,000 less. Commissions don't move that much. They're filling and billing. The other thing about real estate, and this is a nice added kind of bonus to this session, because this is all, you guys are all, for the most part, edge guys are guys. I'm not saying everybody's wealthy or everybody's rich or everybody seems to be at or above average in this community, but realtors, when they put a sign in front of your house, they don't care if they sell it really super quick. They're getting free advertising. And not just people who drive by see their name. That's not what I mean. They're getting, okay, and this is really simple to understand, but nobody ever thought of it this way unless you're a realtor. You get a property, a listing, you put the sign in there, and it says your name with your number. Buyers who aren't working with other realtors call up and say, yeah, I'm interested in this house. Oh, really? Are you working with a realtor? No. All right, let me show you the house I'm listing. Oh, you don't like it? Let me show you another house that are out there. All of a sudden, you picked up clients that you wouldn't have picked up if your sign wasn't in front of that house, if your listing wasn't on Realtor.com. Therein lies so when you're negotiating with your realtor to sell your property, now your realtor is your brother, it's different, but when you're negotiating with a realtor to sell your property, say, hey, listen, you're going to probably get clients that you sell other homes to that come in without realtors. So it's part of the value. Let's work on this, make it win-win. But they don't care if your house stays on the market for too long. They obviously want to keep you happy and sell it and get their commission, but they're making money without selling your home also. Keep that in mind.
There's a quick fact about that in a book called Freakonomics that just goes over data. Real estate agents will leave their house marketed at their original asking price more than twice as long as they will for their customers.
Wait, say that again?
They'll leave when they sell their own homes, realtors, they will leave it marketed at the original high sale price for more than twice as long as they will for a customer of theirs that they will do a sale price reduction. Because they know what sells the house is when the person that walks through the door that wants your house walks through, that's when it's going to get sold. And if they're taking a shot, they're taking a shot. But with your house, they know that they've got to sell it at some point, so they're going to encourage you to reduce your asking price well before they would have.
Sure.
And that's just
yes.
Data doesn't lie.
Data, not right. And not only that, but they have less vested in it than you. $20,000 to you is more than $200 to them. And
yes.
And so they're not always looking. Their interests aren't totally in line with yours. And you need not to be ignorant to that point.
No.
And also don't kid yourself that when another realtor does represent buyers and talks to your realtor, they're sharing information that you would flip and say, why would you tell them that? They're in on it to want to get the deal done so they both can collect their commission. So they're going to say things like, you know what, I think it'd go down, or, things that in a negotiating process you would never want them to say. But again, it's great realtors and a lot of crappy ones, just like in every business that we have out there. But here, real quick, before I go over this, I'm going to end the recording for you guys watching it at some point in the future. But Dan, thanks again, man. This was really great, and we appreciate it.
Anytime.